With the same topic, but maybe a little bit of a different focus in terms of the asset. Alan, you can share your thoughts given the focus on transitional loans and investor loans where the asset itself is much more of the focus of the underwrite. What observations can you share around the diligence requirements or enhancements to the process itself from your perspective?
Sure. It's actually not all that different today relative to consumer purpose non-QM product. When we first got into this industry back in 2014, 15, the transitional asset was still a very novel concept. The institutional world hadn't quite embraced it yet. And over the last 5-6 years, it's grown tremendously in popularity. And just the universe of potential capital providers that are looking to purchase those assets has grown. So with that growth has come more of an institutionalization of that product. When we were selling these loans years ago, there was no TPR process. It was mostly private equity groups and hedge funds that were purchasing and doing all their diligence in-house. There was no securitization of the product on the back end. It was a higher coupon product at the time before we had significant rate compression in our industry. So people would buy this stuff and just keep it on their balance sheet. As the market demand has increased, the competition has increased, we've seen more institutional capital come into the space over time. We've seen rate compression, and it's kind of followed the pattern of non-QM consumer loans and even qualified consumer loans. Rates have come down. The type of capital purchasing these loans has started now, leveraging it through warehouse facilities, ultimately looking to securitize it on the back end. So the process has become homogenous with that. We likewise will work through TPR firms, different TPR firms, depending on who the buyer of the loan is, especially more recently since AMC has unfortunately cut off many of their prior clients. So there's been kind of this mad dash in our space, and I'm sure the others on the call have seen it as well, for new TPR firms and smaller TPR firms to capture market share. So whether it's companies like Consolidated Analytics, EdgeMac, Covius, Clayton, and others that have come into this space and trying to capture that market share and absorb the volume, nonetheless, it's still resulted in quite a bit of a delay in that process. So we used to be able to load up a loan and sell it from presentation to sale was no more than 2 weeks. That's probably trending more like 3 to 4 weeks now, so almost double the time. And there's just a lack of help. And then on the securitization side, I mean, the requirements and the underwriting guidelines have kind of followed a similar pattern as well, where we used to not require a project feasibility study for a construction budget. That's now a requirement. That's something that rating agencies are going to look at, that TPR firms are going to look for, because they know it's going to help improve credit quality when they go to securitize. Requiring something as basic as a letter of explanation for a credit event on a credit report used to be something that we didn't care about back in 2015 and 16. Now you can't close a file without one. And then as far as like COVID overlay type stuff, our space has more or less returned to where it was pre-COVID. I think there's, on the term side, there's still a little bit of hesitation and a bit of an overlay on slightly lower loan-to-value ratios, maybe by 5 points, and also factoring for larger expenses and haircuts on things like vacancy rate. But I'm slowly starting to see that fade away, and my expectation is that within a few months that we'll really truly be back to where we were pre-COVID in terms of credit quality and characteristics.
Yeah, that's great. So it sounds like with institutionalization of the product and placing the product in more hands has brought with it just more requirements that sounds like you've incorporated into the process and the diligence and the product makeup at this point. All good development, sounds like.
And this always happens with new asset types. It was something novel. It was very early on in its infancy. And the longer an alternative asset is around, before you know it, it's not really an alternative asset anymore. It's something that the institutional world embraces, and they try to squeeze as much juice out of it as possible. We've headed that direction.
Makes sense. Natural progression of things.